A recent survey by JLL showed that in the survey that they had conducted, about 56% of companies were waiting until the second half of 2021, the second half of this year, to make the decision whether to return to the office. But one of the areas where there is a very strong consensus is the idea of the hybrid model, where many people would like to choose to work from home on a flexible basis. And 3 out of 4 firms surveyed said that they felt they would probably expect about 20% of their workforce to work from home on average 2 days a week. And over half the firms expected to increase the amount of floor space per person when people did return to the office by as much as about 20% for health and hygiene factors, and primarily to accommodate perhaps different styles of working that might be much more collaborative. On balance, the working from home factor kind of seems to come out evenly. But in any situation, in an economic downturn, there will be some companies, some organizations that have not survived the pandemic terribly well, and they will need to give back space. And so we might see vacancy space coming to the market from an economic perspective, almost regardless of what happens from working from home.
A clear path to carbon footprint reduction is definitely something which we are observing in terms of what investors and tenants are looking for in their different acquisition. And that's something which we are paying increasing attention to, meaning have a clear path to reduce carbon footprint in all the office assets we are acquiring. A second theme which we're looking at is well-located central offices. The other aspect, of course, we're looking for is, high tenant experience. Tenants want more amenities. They want more technology in their buildings. Then finally, I should add that mixed-use concepts are also becoming more and more popular in acquisitions. It can even go back to very old historical buildings. Even old buildings are able to be transformed and be very attractive, especially if you can position them as mixed-use building, mixing up different usages in one asset.
What you're seeing today in our portfolio and really nationwide is limited tenant defaults today. If you even look at CMBS as a barometer, less than 2% of the CMBS universe has office loans that are in delinquency. So again, tenants aren't defaulting, but I would be concerned about secondary office and secondary locations, which you think about your typical tenant there, it could be a 15,000-foot small law firm, partner owned, that hasn't de-densified yet. That's where you're going to see those pressure, but that will accumulate over time and build again in 2022 and beyond. But in terms of our investment activity, we've been somewhat contrarian. We've actually acquired 2 vacant office complexes in Silicon Valley over the past 9 months. In Silicon Valley, these are heavy R&D, research and development types of markets, and you really can't test hardware at home. So we see less pressure in those markets, and we felt the broad paintbrush against the office market was a little bit overblown. Lastly, I'll note that we are seeing capital come back to the office market, particularly in those New Yorks and San Franciscos, in those limited transactions. As a real-time example, we recently pursued a lease-up office deal in Manhattan where bidding competition accelerated quite dramatically over the last 60 days, ultimately resulting in the winning bid going above about 10% plus above broker guidance. So similar to the housing market today, you're seeing capital come back and you're seeing some accelerated bidding activity.